Most students mix up goods and assets, and that confusion makes accounting feel impossible. But once you understand this one difference, everything clicks. Knowing the difference between goods and assets helps a business figure out what it uses to run daily and what it sells. This makes planning, budgeting, and talking about money much easier. It's not just theory. Businesses do this every day. If you don't learn it now, it will be harder to manage money later. Most students struggle with accounting not because it's complex, but because words are reused with different meanings. Goods and assets are one of the most common examples. The same physical item can be called both or neither. That's where confusion starts. In this video, I will break this down step by step using simple logic, everyday examples. By the end, you will recognize the difference instantly. Both goods and assets are things a business owns. Both are valuable. So, what's the difference? The purpose. Remember the word purpose. Why they are purchased. Goods are items kept mainly to be sold is part of regular business activity, while assets are items kept being used over time to help the business operate. The same physical item can be either goods or an asset, depending on how it is used. In accounting, classification depends on the role an item plays in the business, not on what the item looks like. Goods are purchased to be sold. The goal is not to keep them forever. Goods are items a business keeps mainly to sell. They move in and out regularly. Their purpose is conversion from items to sale, not long term use. If something is waiting to be sold, processed, if something is waiting to be sold, processed, or traded, you are likely looking at goods. Think of goods as a flow of items. They come in, get transformed or packaged and get and go out. They don't stay long and the business doesn't depend on them to operate daily, only to trade. Here is quiz. If it's sitting on a shelf waiting for a customer, what is it? Assets are items owned for long term use in the business. Assets are tools, resources, or rights that help a business function. They are not meant for immediate sale. Instead, they help generate activity over time. Assets are owned to support business operations like machines, buildings, or computers. If removing an item would slow or stop operations, is probably an asset. Assets stay. They are kept to support the business. They give value over many periods, not all at once. Even if they slowly lose value, they are used, not sold. The easiest way to remember the difference assets support goods sell. If you remember support with sell, you will rarely confuse them again. Here is the common trap. The same physical item can be good in one business and an asset in another. That doesn't mean accounting is confusing. It means accounting looks at how the item is used, not what it looks like. Let's see how that works. A cell phone in a retail shop is inventory meant to be sold. The same phone on an employee's desk is an asset used to operate. Raw materials are meant to be converted into finished goods and sold. The object didn't change, the intent did. If you remember nothing else, remember this two question test. It it works in exams, assignments, and real life. Ask yourself, is it sold or used? Is it short term or long term? Goods are sold and are for short term. Assets are used and are long term. Comment. A laptop is usually an asset because a business uses it over many years to support work, not to sell it. But in computer shop, their same laptop would be a good because it will be for sale. Many students memorize examples instead of understanding the logic. That works only until the question changes. Then everything falls apart. When you think in terms of purpose, new questions become easier, not harder. Common mistakes. If it's valuable, it must be an asset. Wrong. Value doesn't decide the category, purpose does. If it's physical, it must be goods. Wrong. Physical item can be assessed too. Key idea to remember. Assess can be physical or non-physical, like software patterns. Goods are defined by being meant for sale, not by their form or price. Stop memorizing labels, start asking why the item exists in the business. This is your memory formula. Repeat it clearly. Rule 1. Goods are for sale and for short term. Rule 2. Assets are for use and for long term. Where do goods and assets sit in accounting books? Goods are kept to be sold and so are called inventory. They are placed under current assets in accounting because they turn into cash in the short term. Assets are kept to be used, not sold. They are placed under fixed things because they are for long term. They help the business over many years. Why this placement makes sense? Accounting groups items based on how they stay useful and what the business plans to do with them. Sale soon is inventory. Use for years, fixed assets, that's it. Pause the video and classify each item based on how it's used, not what it is. This is exactly how exam questions test understanding. Delivery bike, warehouse shelves, office computer. Comment and pass and answer these questions too to check how much you have learned. A shop's inventory, goods are asset. A company car, goods are asset. Raw materials, goods are asset. Purpose decides everything. If you understood this, your accounting foundation just got stronger. Goods are for sale, assets are for support. The purpose of the item decides everything, not its price, size, or physical form. If it exists to be sold, it's a good. If it exists to help the business operate, it's an asset. Like, subscribe, and share. If this clicked, comment what topic you want next. Thank you very much.